Oracle shares are higher today after what's been a very brutal few weeks. The AI darling that made Larry Ellison the world's richest man is now down more than 20% just this month alone. Fears about its debt and exposure to OpenAI is weighing heavily on that stock. But none of this comes as a surprise to our next guest, who launched his coverage of the stock, Oracle, as a sell-rated one back in September. Those shares are down more than 30% since that call. For more, let's bring in Alex Haissl of Rothschild & Co. Redburn. So, Alex, this is an interesting call. It was very much non-consensus. What exactly made you make that call at that point, and are you willing to stick with that underperform or sell rating right now?
First, yes, thanks having me on the show again. We stick to our sell rating. We in September, we said it's a risky blue sky scenario that the market is pricing in. Right now, it's still an optimistic scenario. So we do see more downside from here. The reason we have launched in September is because we were expecting a large RPO number because we have seen this target announcements. So from a timing perspective, we thought we have to wait to get this RPO boost out of the way. And the reason haven't really changed because we continue to see these GPU deployments being very, very low value. And I just want to put some numbers behind this. We think that, for every CapEx dollar you spend on these GPU deployments, you only generate 20 cents in NPV. And that's like a fix compared to the traditional cloud. And what we have seen over the past couple of weeks, obviously there have been more cautiousness around the overall AI trade. But also if you see how consensus has moved, we have seen some EPS upgrades. The 2030 moved up by 15%, but at the same time, it cost them 50 billion more if I just take consensus. And it just reaffirms our view that the costs to grow are significantly higher. And from an Oracle perspective, the problem is also that they have to fund the bulk of this with that.
All right, Alex, you mentioned the RPOs, those remaining performance obligations that Oracle has. It was, by the way, one of the biggest reasons for the bullishness in Oracle going into the peak that we saw recently. How has the story around those RPOs and the growth prospects shifted or changed in your mind from an investor standpoint, given the fall that we've seen from the recent highs?
Yeah, I think overall, at this point, it doesn't really matter if we see an increase in the RPO or not, because there's just too much risk associated, and it also means you need more money to fund all of this growth. The other problem that you really face is whatever deals are being signed now won't drive revenues, let's say, in the next 2-3 years. So it's really in the outer years. So the focus has clearly shifted. A lot of conversations we have is, maybe it would have been better having a lower RPO and less leverage, and the stock could potentially be higher without some of these, big deals they've signed.